Welcome back to Today Assets Report, the channel where we cut through the noise and give you the real story behind what's moving markets before it shows up on your screen. And today we are talking about something that has been building for a long time, something that a lot of people in this space have felt but haven't been able to fully explain. We are talking about XRP, Ripple's CEO Brad Garlinghouse, and a price trigger that could change everything you thought you knew about where this asset is headed. Now, before we get into the data, I want to be honest with you about something that most people in crypto don't want to say out loud. For years, XRP holders have been sitting on a story that kept getting pushed forward. Banks are coming, institutions are loading up, the utility is already there, the price just needs to catch up, and a lot of people believed that. I believed it, most of this community believed it. But here's what the actual data shows, and it might surprise you. XRP has not been utilized at institutional scale, not even close to what was promised. Every single price move you can point to on that chart, every rally, every spike, every run-up was driven by retail investors, by you, by people exactly like you, buying and selling and holding through years of frustration and sideways price action. Not by the banks that were supposedly already building on it, not by the financial institutions that were supposed to be quietly loading up while retail slept. So that raises a question that should genuinely be keeping you up at night. If influencers and analysts have been overstating the institutional story this entire time, and the actual institutional wave hasn't even begun yet, then what exactly has been moving this price? And more importantly, if retail investors alone, without a single major bank settling cross-border payments on XRP, pushed this asset to nearly $4 per token, what does the price look like when just 25% of institutions actually follow through on what they have already publicly stated they are planning to do in 2026? Stay with me, because the answer to that question changes everything about how you should be thinking about your position right now. Here is what makes this conversation even more urgent. A brand new survey just dropped. 351 institutional investors polled, published by Coinbase and Ernst & Young, and the numbers do not match the narrative that has been sold to retail for years. Welcome back to Today Assets Report, where while everyone else in this space is chasing price predictions and riding hype cycles, we decode the actual data behind the moves that institutional money makes before those moves ever show up on your chart. And if this is the kind of analysis you have been looking for and not finding anywhere else, you already know what to do with that like button. It costs you absolutely nothing, and it tells the algorithm that this conversation matters. Here is what we are walking through today. That survey is the key. Those numbers point directly to a gap between where institutions actually are right now and where they have told the world they are going. And inside that gap is the exact opportunity that most retail holders are going to misread, mistiming, or miss entirely. So let's go back to that first question, because the answer matters more than most people in this space are willing to admit. The reason XRP has not moved the way you were told it would is not because the thesis is broken. It is because the thesis was being applied to a version of XRP that could not legally or technically support institutional participation until very recently. Think about that carefully for a moment. The XRP ledger, until permission domain structures were introduced, gave institutional players absolutely no way to verify who was on the other side of a transaction. And without that compliance layer, regulated institutions, banks, asset managers, global custodians, they could not touch the public ledger. Not because they did not want to, because their legal departments would not let them. Their compliance officers would not sign off. Their regulators would not allow it. So what were all those price moves you kept celebrating? Retail. Every single one of them. And here is exactly why the number nearly $4 is the single most important data point in this entire conversation. The global cross-border payments market settles $150 trillion every single year. That is not a typo. $150 trillion running on infrastructure that was built in the 1970s. Slow, expensive, fragmented, completely outdated. XRP is not competing with Bitcoin for store of value dominance. XRP is competing with SWIFT, and SWIFT moves money for the largest financial institutions on the planet. Here is what I personally believe, and I want to be very direct with you about this. If retail buying and selling alone, without a single institutional settlement happening at scale, could push XRP to $3.84, then the version of XRP that is actually being used to settle institutional cross-border flows represents a completely different category of demand. Not 10 times more demand, not 20 times more demand. We are talking about a market that dwarfs everything retail has ever thrown at this asset combined, and it has not started yet. But that is still not the full picture because there is one specific number in that institutional survey that reframes this entire conversation, and I have not shown it to you yet. Let's talk about what the data actually says, because this is where the gap between the narrative and reality becomes impossible to ignore. Start here. Right now, 18% of those 351 institutional investors surveyed already hold XRP. That sounds meaningful at first, but when you see it in context, it tells a completely different story. Of all the XRP held through spot ETF products, 84% of that exposure is retail. 84%. Which means that despite XRP being positioned for years as the institutional asset, the banker's coin, the bridge currency for global finance, the institutional money that has actually shown up to date represents a tiny fraction of the total position. The overwhelming majority of XRP holders right now are everyday people, not trillion-dollar institutions. Now move to the next number. Goldman Sachs currently holds approximately $54 million in XRP ETF exposure. That is a name that carries enormous weight in global finance. But $54 million is a line item for Goldman Sachs. It is a test position. It is not a conviction bet. Real institutional participation looks completely different from that. And it happens after regulatory clarity gives major institutions the legal permission to go all in. Now here is the number that changes the entire frame of this conversation. 25%. That is the share of surveyed institutions that say they plan to add XRP to their allocations in 2026. And separately, 65% of institutions surveyed said regulatory clarity is the single top factor determining whether they increase their crypto exposure at all. So connect those two data points and think about what they mean together. You have 25% of institutions already ready to allocate and stating that publicly. But 2/3 of the entire institutional investor base is still waiting for a legal signal before they move a single dollar. That signal has a name. It is called the Clarity Act. And right now, that one piece of legislation is the locked door standing between your current XRP price and a structural demand shift that retail buying simply cannot replicate on its own. The question is not whether institutions are coming. The question is what exactly unlocks the door, and how close are we to that trigger being pulled? Here is exactly what Brad Garlinghouse, Ripple's CEO, said recently, and I want you to pay close attention to how he framed this because the precision of his language matters. He said if clarity gets codified into law, it is an unlock for the banks, particularly in the United States. He said banks have told Ripple directly, we understand you won the lawsuit, we understand XRP is not a security, but we need it written into law before we lean in. Read that back slowly. These are major U.S. financial institutions. They are not waiting for XRP to prove itself technologically. They are not waiting for Ripple to win another legal battle. They are waiting for Congress to remove their legal exposure entirely. That is a completely different kind of waiting than anything most retail holders have been imagining. And it means the moment that legal exposure disappears, the timeline to institutional adoption compresses very, very fast. This is not speculation. This is what the banks themselves have communicated directly to Ripple's leadership. Now let's anchor this to what it actually means for someone holding XRP today, because this is where it gets personal. If you are holding 1,000 XRP right now, you are positioned in an asset that retail alone, without a single major U.S. bank using it as a settlement layer, has already taken to nearly $4 per token. Think about that. If you are holding 5,000 XRP, you are sitting on a position that was built before institutions were even legally cleared to participate at any meaningful scale. And if you are holding 10,000 XRP or more, you are holding a position that exists in the exact window between retail price discovery and institutional demand discovery. And those two things have never happened simultaneously for this asset, not once in its entire history. The retail chapter is what you live through. The institutional chapter is what has not started yet. And understanding that distinction is what separates the people who will look back on this period with satisfaction from the ones who will look back with regret. Here is what the institutional side of this story actually looks like on the ground right now, because it is more advanced than most retail holders realize. While retail is watching the price move sideways and questioning everything, institutional product issuers are already building the infrastructure. 21 Shares, one of the few firms that already has a live XRP product in the market, published a detailed outlook in January laying out three specific pillars for XRP's price action this year: regulatory clarity and capital accessibility, investor demand for US XRP spot ETFs, and real-world adoption of stablecoins and tokenized real-world assets on the XRP ledger. That is not speculation from some anonymous analyst. That is a firm with actual skin in the game, real products, real investors, mapping out exactly what has to happen for XRP to make a sustained move. And every single pillar they named points back to the same catalyst: regulatory clarity. That theme keeps coming up because it is the actual answer. Now add this layer on top of everything we just covered. Ripple is actively building what they are calling an institutional DeFi portal for the XRP ledger. It is in development right now, today, as you watch this video. And think carefully about the timing of that decision. This is not a retail-facing product. It is not a consumer wallet or a mobile app. It is an institutional gateway, purpose-built to go live at roughly the same moment regulatory clarity is expected to fully resolve. Think about what that means for you if you are holding XRP through this period of quiet, frustrating sideways price action. The infrastructure being assembled right now, permissioned domains, institutional DeFi rails, stablecoin settlement systems, real-world asset tokenization, none of it has been stress-tested by real institutional capital yet. That is not a weakness. That is the setup. The rails are being laid before the train arrives, and the train is the one carrying the money that changes the price permanently. Here is the number that anchors all of this in reality. Tokenized assets on the XRP ledger saw over 2,000% growth. That is not a forecast or a prediction from an optimistic analyst. That has already happened. And institutional players have barely scratched the surface of what is possible on that network. So the real question becomes, is there a specific event, a specific defined moment that acts as the trigger for all of this to accelerate at once? Yes. And it is closer than most people in this space are giving it credit for. The Clarity Act, the exact legislation Brad Garlinghouse called the unlock for U.S. banks, has a primary catalyst window opening right now. The SEC litigation that clouded XRP's legal status for years reached its definitive conclusion in August of 2025. The legal cloud dissipated. But here is the critical distinction that most people are missing. Dissipation and codification are two entirely different things. What the banks need, what 65% of surveyed institutions said they require before increasing their crypto exposure, is not a court ruling. It is a law. The Clarity Act is moving through a legislative environment more favorable to cryptocurrency than any point in the last decade. That window does not stay open forever. Political landscapes shift. Congressional priorities change. And the institutions that are going to move the moment it passes are absolutely not going to telegraph their positioning in advance. They never do. That is not how institutional capital works. Here is what the supply side of this looks like for you personally, and this part matters a lot. XRP's total supply is fixed. Ripple releases tokens from escrow on a scheduled, predictable cadence. There is no emergency lever, no mechanism, no button anyone can push to create more XRP on demand. If 25% of institutions follow through on their stated 2026 allocation plans, that demand enters a market where supply mechanics simply do not adjust to meet it. The market has only one way to balance supply and demand when supply is fixed. The price has to move. That is not opinion. That is basic market structure. Look, if you made it this far in this video, you are not a casual viewer just looking for a price target to screenshot and post in a group chat. You are someone who genuinely wants to understand what is happening beneath the surface of the price action you see every day, and I want to speak to that directly right now. I know exactly what you are feeling. The price is flat. The legislation keeps getting delayed. Every week there is a new reason to question the thesis. Every time you check your portfolio, it looks the same as it did 3 months ago. And somewhere in the back of your mind, a quiet voice is starting to ask whether the people who sold already knew something you did not. I hear that. I have heard it from people in this community more times than I can count. But here is what I need you to understand. And this is not motivational content. This is pattern recognition built from watching how assets move from speculative to institutional. The period of maximum retail frustration has historically been the period directly preceding a structural re-rating. Not in every case, but in the case of assets making that specific transition, almost every single time. The frustration you feel right now is the silence before institutional bids arrive at scale. And the single biggest risk you face in this moment is not that XRP fails or that the thesis turns out to be wrong. The biggest risk is that you sell the exact position you built cheaply, patiently, and correctly in the 6 months directly before the Clarity Act passes and unlocks institutional access at the law level, and then you watch the move happen from the outside, holding cash, wondering what went wrong. I personally believe we are closer to the breakout than the current price action suggests. And the one signal I am watching is not the XRP price chart. It is the Clarity Act legislative calendar. Because once that law passes, the banks that have been sitting on the sidelines with their legal departments blocking the door do not trickle into this market. They come with allocation mandates, treasury positions, and settlement contracts already written. That is a different category of buying than anything this asset has ever experienced. And when it arrives, the people still holding will understand exactly what this window was. Today, Assets Report will be right here when it happens.